Hey, welcome back to FiscalVoyage. My name is Felix, and today's video, the market is down again. It went as down as almost 3%. Right now, the S&P 500 is down 2.46%. And today's video, we're going to talk about 6 different companies that, because of this weak, big downturn, presents very attractive opportunities. Just because the market is down about 5% in a week or so, this presents a buying opportunity for a lot of different companies. But in this video, we're going to talk about the 6 that are some of my favorite companies. And don't think of this as, oh my God, I'm losing money. Think of it as an opportunity to get more shares at a cheaper price. But before we get started, if you're new to the channel, make sure to hit that subscribe button, as well as check out my free ebook in the description below. So you see here the S&P 500 right now is down 2.58%. You can see here there's been a drop since the 23rd. At the 5-day average is down 1.5%. But we're going to cover the 5 different stocks that are very attractive, and there's a lot more other stocks that are very attractive, but I'm going to just talk about 5 in this video. The first one I want to cover is British American Tobacco, ticker symbol BTI. So you can see here the stock is down 2%. You can see here earnings. This is forward. This is expected earnings for 2020, $4.18, and a dividend rate of $2.69. So that's almost a little more than half a payout ratio, about maybe 55-60%. But you can see here outstanding yield 8.23. And if we look at the fast graph for British American Tobacco, you can see here the company has been growing earnings very nicely throughout the years. They did have some down years in 2014 and 2015, but you can see here in 2017 they grew by 28%, 2018 they didn't grow, and then 6% in 2019, and even with all the things going on in 2020, they're expected to grow earnings about 3% for the year, and then 21 7%. But you can see here, if we look at the 5-year chart, you can see here the company is basically, the stock market likes to give this a normal PE about 15 or 15 normal multiple, and you can see here right now the company has a PE of 7, and with the earnings yield of 13. Again, here's the dividend of 8.15 outstanding dividend yield, and this is from yesterday's closing price, so it's down about 2% today. And you can see here, if the company were to revert back to a normal multiple of 15 or even a 10 or 12, you have a very attractive annual rate of return, about 51%, maybe 40% for the next few years. And it's BBB plus credit rating, so it's investment grade. Long-term debt to cap is under my criteria of 50%. So overall, solid company. Let's look at the second one. The second company I've talked about before, ABBV, ticker symbol ABBV. You can see here is down 2%, 2.13% for the day, $80.95. Earnings are expected to be at $10.42, giving it a price to earning ratio of 7.9. Again, this is from yesterday's closing price. So this price to earnings ratio is going to be much better because of the 2% drop today. Dividend at 4.75, so it's less than 0.5% of the payout ratio, and a very nice dividend yield of 5.71. And if we look at the fast graph for ABBV, you can see here the company has been growing earnings very nicely. This year they're expected to grow earnings at 17%, and in 21, 16%. So if we shorten this time period to a 5-year chart, you can see here the market tends to give this company a normal multiple around 12 or 13. So we look at that, and this is from yesterday's closing price. You have a very nice annual rate of return, about 44%, if we reverted back to this mean of 44 at 12 or 13 PE. You can see here 12.31% earnings yield. I like to see this at 6.5 and 7% or higher. Very nice dividend yield, BBB plus credit rating, investment grade. The only downside is the debt. It is pretty high at 80%, but they have enough free cash flow to cover the interest payments and and tackle that debt. So very solid company here and a very attractive price. So let's look at the third one. The third company that's very attractive right now in this market downturn is Bristol Myers Squibb. Right now it's at $58.02. It's down 1.23%. Ticker symbol BNY. You can see here earnings for this year is expected to be $6.28, giving it a PE of about 9.36. Of course, it's going to be a little lower, the PE, because it's down today. Dividend rate of 1.8. So it's less than 20-30% payout ratio. Very nice yield at 3.06. if we look at the fast graph for Bristol Myers, you can see for the past few years, earnings has been growing outstanding. 41% in 2016, 6% in 2017, 32% in 2018, 18% in 2019, and they're expecting a 34% growth in earnings for 2020, 19% in 2021, and 8% in 2022. So this is going to give the company outstanding performance once the market realizes how undervalued this company is. And you can see here, if it reverted back to the mean of about 18 PE or even a 15 PE, is still very attractive. Right now the company has a PE of 9.8. This is yesterday's closing price. So this PE ratio will drop slightly because it's down about 1% or so. And you can see here your total annual rate of return projection could be about 53% for the next few years if it reverted back to the mean. The company is very solid, A+ credit rating, great credit rating, investment grade, good long-term debt to cap ratio of only 44%, earnings yield at 10%, higher than the 6.5% to 7% I like to look for. Dividend yield decent at 3.6%, and this company has been growing dividends for a substantial amount of years. So overall, very attractive company right now. Price looking really good. PE, earnings, all look good. So let's look at the next company. So here's the fourth company, General Dynamics Corporation, ticker symbol GD. Right now it's going for $134 a share. It's down slightly, 0.5%. But what makes this company attractive is that its expected earnings of $11.04, giving it a PE of about 12.2, and a dividend rate of 4.4. So the dividend payout ratio is much lower than 50%. It's about 40%, maybe high 30%. Yield decent at 3.46. If we look at the fast graph, you can see here the company has been growing earnings very nicely throughout the years. It did have a down year in 2016, only 5%, and in 2012, 7% down. This year, of course, with all the things going on, this is one of the companies out of the ones I talked about so far is expected to be down this year about 8%. However, you can see 2021 and 2022, they're expected to be up 9% or 11%, and it was showing this time period. The market over the past few years gave it a normal multiple of 16, but we're just going to use a normal multiple of 15 to kind of be conservative here and look at, kind of worst case. Earnings yield of 8.32, very attractive. Beats my criteria of 6.5, 7% or higher. Credit rating A, investment grade. Low debt to cap ratio, outstanding. The dividend, like I said, 3.26. And if the company were to revert back to a mean of about 15, you can see here you can have a 23.1% total annual rate of return for the next few years, which is very attractive rate of return, 20% plus. So these companies are outstanding dividend growth company, and they've been growing dividends for for years. And the best part is they haven't froze or cut the dividends this year, with all the economic shutdown and things like that. They've just been profitable. The other three that I mentioned, earnings are expected to be higher. This one is just expected to be down, but not too much. And you can see here it's back to growing, or analysts are expecting to grow back again in 2021 and 2022. Intel Corporation, another high quality undervalued stock, has had a few bad quarters. You can see here in August it dropped tremendously, about 12%. Then it picked up nicely, but then it dropped again for Q3 because of the chip not coming through. Revenue was down and things like that. But all this does presents a great buying opportunity because Intel Corporation is very cyclical type of company where it has years where it's up, years where it's down, and things like that. So this year is expected to be down earnings, and we'll look at that in fast graph. But this presents good buying opportunities. It's down 2%. You can see here for today. Earnings forward for the year is expected to be at $4.88, giving it a PE of about 9.3. And this is not including the price, the current price, so it's actually a little lower. Yield is decent, 2.89. Dividend rate at 1.32. So you can see here is about 30 to 40% payout ratio. But if we look at the fast graph, you can see here, like I mentioned, there's been years where Intel earnings dropped. You can see here in 2012 and 2013, it dropped 11%, and then this year is expected to drop 5%, but picking up nicely at 9% for 2022. But this is what I'm talking about, where it's a very cyclical type of company where it ups and downs in earnings. But the best thing is that the price right now is very much undervalued, based on fast graph and other metrics you could look at. If you see here, earnings here at 10.7, blended PE of 9.34. Again, this is yesterday's closing price, so it's down 2%. So this is going to drop a little more. It's been growing very nicely at 11.7% for the past 5 years. High quality company, A+ investment grade, and 32% long-term debt to cap ratio. So it's outstanding balance sheet. And you can see here, if we revert back to the mean of about 12 or 13, you can have a nice total annual rate of return of about 21% once the company reverts back to the mean. So it's a very attractive price right now. And the last company that we're going to look at is Lockheed Martin. Outstanding company, high quality company, is down 1.56. You can see here it was high as $390 and now is at $356 a share. Great buying opportunity, has a P of 14.7. This is not including that is down 1.5%. Earnings expected to be at $24.51 for the year, and they have a payout dividend rate of $10.40. So it's under 50% payout ratio. The yield is decent at 2.87, but it is much better than the S&P 500. And if we look at the fast graph for Lockheed Martin, you can see here the company has been growing earnings very, very nicely throughout the years. This year they expected to grow about 12% in earnings, outstanding considering all the things that have been going on. And in 2021, 7%, and in 2022, 7% as well. And you can see here in 2018, the company had a PE of about 14.89, and in March, it had a PE of about 15. And right now, you can see here has a PE of 15, and this is from yesterday's closing price. So with today's down market, the PE might be under 15 and presents a nice buying opportunity. It'll be under the orange line, which is normal multiple of 15. And the market tends to evaluate this company about an 18.9 or 19. And if you were to revert back to the mean of about 18 or 19, you can have a nice total annual rate of return about 21.8% on such a high quality company. The earnings yield is slightly lower than the other ones we talked about at 6.64, but it's still at my criteria 6.5 and higher. So that's very positive there. Again, the yield is low at 2.87, but it is much better than the S&P 500 yield, which I think is about 1.7 or 1.8. S&P credit rating of A-, investment grade quality. The debt and to cap ratio is pretty high at 66%, but it is a very capital intensive company. But the overall, you can see here with the A- credit rating, the balance sheet is very solid. So this is why Lockheed Martin made it in the cut in this video. I find it to be a very attractive company and a very great price at current price. So there you have it. Those were my 6 high quality dividend growth stocks right now with the market downturn. They present great buying opportunity right now. I wish I had money to buy a lot more shares at current prices, but I ran out of money. But overall, these are high quality companies. I think you guys should definitely do your research on these companies and look more into it. But all 6 of them are high quality dividend growth stocks. Again, there's likelihood that the market will drop even further as the election nears. So there's very possibility. But what we do know now is that today's price are very attractive. We don't know how it's going to be tomorrow or on Friday or on Monday. But we do know that today's price are very attractive of these 6 companies. So I think you guys should definitely check them out. And let me know in the comments what's your thought of these 6 companies. And are you buying, or what other company are you buying in today's market? So thank you for watching. Let me know in the comments. And if you're new to the channel, make sure to hit that subscribe button. And I'll see you guys in the next one.